Hi everyone, welcome back to my YouTube channel. I have to apologize in advance. I've been a little bit sick for the last 6 days. I kind of lost my voice. Still haven't recovered fully, but I thought it's good enough to make another video. I wanted to talk about the purchase that I made about 10 days ago. And basically kind of go into why I purchased that company. So let's begin. I'm sure most of you know this because no matter whether you open the internet, go to some news site, or turn on the TV and watch something like cable news or something like that, right now everybody talks about how prices and everything is going up, and basically just inflation is a little bit out of control.
It has to be. It's now the default position of the Fed at its December meeting to discuss and likely enact a faster pace of taper, or as J.P. Morgan calls it, the turbo taper. In fact, J.P. Morgan writing this, it now looks like it will take a deterioration in the virus conditions to prevent the FOMC from deciding to quicken the pace of tapering at the next meeting. That's December 14th and 15th, of course. So now it's up to the new variant to prove it's bad enough to dissuade the Fed. Powell's comments came along with the Fed chair retiring the word transitory to describe inflation and otherwise raising his level of concern over prices. So what does this look like? Well, roughly every $5 billion increase in the taper announcement would bring forward the end of the Fed's $120 billion in monthly asset purchases, which are designed to help bring down interest rates. So if it doubled from the current pace of $15 billion to $30, the Fed would end the asset purchase around February with a little bit left over instead of May. I think that may be the odds-on choice here, that the Fed doubles it. That faster taper, of course, raises the possibility of quicker rate hikes. But it's worth noting commodities, including oil, have all declined sharply. So both with the new virus scare and with Powell's comments. So it could be that a faster taper will do some of the heavy lifting in controlling inflation, limiting how fast rate hikes come or how far they have to go. Andrew?
Were you surprised that he threw in the towel on the word transitory after all this time?
No, I think he's been going there. That was not my surprise. My surprise was that he didn't wait a month before deciding on the faster taper. I went back and looked at the transcript, Andrew. I want to find the exact words that he used. But he said at the last meeting, remember that last meeting was only in the beginning of...
Here I have a graph that I found that basically demonstrates usually governments, at least in US and Canada, the government tries to keep the inflation between 1 and 2%, right? They don't want to have zero because, they kind of want the inflation to be a little bit there because it helps them pay for the services and stuff, because the money that they pay becomes less in the future, because basically it loses the value, right? Because that's what inflation does. But at the same time, they don't want it to be too high, because then just the prices go out of control. And if it gets really bad, people wouldn't be able to even afford basics. So the idea is to keep it between 1 and 2%. And you can see that it's been kind of like that last year until the beginning of this year, right? And here in April, you can see all of a sudden it jumped from the 2.6, which was a little bit higher than usual, to 4.2. Then in May, it was 5, and just stayed about 5%. And actually in October, it was 6.2, which is actually very high. And so that kind of got me thinking about it, right? Because, well, you may or may not know about it, but the way government deals with the high inflation is by raising the interest rate, right? Because if the interest rate is high, people don't have ability as much to borrow money, and that in theory should bring the prices and everything down. And so I thought, well, what kind of company can I invest in that will benefit from the higher interest rate? Because not every company will benefit, obviously, right? Because if the company needs to borrow money to, let's say, build a warehouse or anything like that, or build an apartment building, well, now it's going to actually cost them more in interest, which means the bottom line, like the profits, will fall. On the other hand, if the company somehow can benefit from the rising interest rate, their revenue will grow, the profits will grow, and that should drive the price for the stock higher. Well, the biggest beneficiaries of the high interest rates are financial institutions, banks. So I decided to purchase a bank stock. Now, here's another interesting website that I found that shows historical interest rates for mortgages, and you can actually see that they are going up already. So here you can see January of 2020, the interest rate here in Canada, in Alberta, was, well, the lowest one you could get was 2.64, and the average or highest, whatever this one is 3%. Then a few months later, as coronavirus hit, you can see in June it started to go down. Well, it started to go down really even before, right, in March. And then it was staying low until the January of this year, 1.43%. But after that, it's starting to slowly increase, right? And right now it's sitting at 1.74%. That's the lowest you can get for 5-year mortgage. And beside this, I just simply know, I've heard it more and more often everywhere, that basically the interest rate will be increasing a lot sooner than they hoped, right? Because before they were talking that the inflation is transitory, that we should not worry about it and nothing should be going to have to be done about it. But now they're starting to think that's not really the case, and they have to do something about it because it seems to be running out of control. And so I decided to invest money in bank stocks. I went with a Canadian bank, which is called Toronto Dominion Bank. For those who are in the United States, you can also purchase stocks in this bank because it's traded on New York Stock Exchange. Interesting fact about the Canadian banks, and I have mentioned this in my previous videos, a lot of Canadian banks been paying uninterrupted dividends for a very, very long time. For example, the Toronto Dominion Bank paid uninterrupted dividends since 1857. Just imagine, 160 years of paying dividends without stopping. Now, just because the bank is in Canada doesn't mean it doesn't have exposure to the US. As you can see, 34% of net income comes from US. But they specialize in things like car loans, mortgages, personal loans, credit cards. Some of the money comes from the fees and stuff like that. Also, what I like about it is that TD has little exposure to investment banking and trading operations, which tend to be more cyclical and riskier business. And that's, for me, very important, because I do dividend investing because I want that to be my retirement income. And for that, I want it to be very, very stable, right? Because just think about it. The last thing you want, for another COVID happen or anything similar to that, right? Markets crashing, things going sideways, it's hard to get jobs and stuff. And all of a sudden, the only income that you were expecting to be stable and, that you're relying on, all of a sudden they decide to cut their dividend. Because that's exactly what most of the American banks did, right? In 2008, when the financial crisis happened, most US banks cut their dividends because, well, first of all, some went out of business and most of them had to be bailed out by US government. For example, let's look at JP Morgan history, right? You can actually see that what's happening. The yield, they were paying 3-4%, right? And then financial crisis happened and the yield basically dropped from, 4-5% to 0.5. Well, when everything else is crashing, when the economy is bad and stuff, that's the last thing you want to worry about is the income that you're depending on to be gone. And that's why I like idea of investing in Canadian banks. Don't get me wrong though. I have to be clear. I do own some JP Morgan. I also own Citigroup. But the majority of banking that I own are in Canadian banks. There's not a lot of companies you can invest in Canada because, we don't have companies like Procter & Gamble or Johnson & Johnson, right? Those huge companies. In Canada, you can invest in banking and you can invest in energy sector. And that's kind of how I get my diversification. About 2/3 of my stocks are actually US based companies, and about 1/3 is Canadian companies. And most of the Canadian companies I own are basically in the banking and in energy sector and telecom as well, right? Because this day and age, everybody wants to use the cell phone. I don't think those companies going anywhere anytime soon. Also, what I like about the Toronto Dominion Bank is when I looked at their financial statements, something caught my eye. So here you can see that they made almost $16 billion net income. You can see that they paid in dividends $4 billion. So that's, pretty good payout ratio. Like, it's very low, right? But what I also liked is the fact that they seem to be doing a lot of stock buyback. You can see in 2018 they did $10 billion in buyback. 2019 they did $12 billion buyback. 2020 they did almost $10 billion in buyback. And now again it's going to be $11 billion in buybacks. So if you look at their dividend plus the buyback, the total return to shareholders is over 10%. That's pretty good, And because of that, I bought basically $4,000 worth of shares. Right now, they are also a little bit cheaper than some of the other Canadian banks. Because Royal Bank is, just as good purchase as well as the BMO. But right now, all things considered, I think TD Bank gives you the best bang for your money. It's a little bit cheaper than the other banks. And so this is why I decided to go with this bank. Here, another page, you can look at some of the interesting statistics for this stock. You can see their annual yield at the current prices are 3.27%. The payout ratio is 37%. The trailing PE ratio is 10.83%, which is fairly low. And price to book ratio is 1.8. It's not ideal, right? But if you look at the history for the last year or two for Canadian banks, well, actually, even for American banks too, right? They went up a lot. I already owed some banking stocks, but right now I simply wanted to take advantage of the interest rates that I have a feeling will be going up very soon. I've been investing for a few years, and to be honest, I'm still learning. I'm realizing that the best performing stocks for me are the companies that are actually, I didn't think gonna do all that well. I mean, I bought them because of the safety, but I definitely didn't think they're gonna go up as much for me. And the worst performing companies for me are the ones that I wanted to buy without thinking even that I'm going to be holding them for long. I just wanted to make a quick buck. To give you an example, like some of my best performing companies are, for example, Procter & Gamble, which I bought initially a little bit, and it just keeps going up and up and up, right? And to me, that was like the safest bet. I obviously should have bought a lot more of it, but my thought was, well, it's so big. How much bigger can it go, right? And it's boring. It's a very boring company. It's not the same as Tesla or something else. Procter & Gamble, I'm sure you know what they make. They basically make Downy dish soap and Pantene shampoo and some soap and laundry detergent, Tide laundry detergent. It's very boring business, but boy, do they make money. And when the company makes money and growing, it shows in their stock. Another company that basically I did very well on is Walmart. It more than doubled for me since I bought it. Same thing, right? Very, very boring. But I remember reading books and stuff, and one of the things that everyone talks about to invest in, basically companies that you know and you understand. Well, I shop at Walmart, I know them, so I decided, I'll buy their stock. That was before, I could even read financial statements. I simply knew that, hey, they seem to be everywhere and they seem to be doing very well. And yeah, their stock just doubled for me and just keeps going up. On the other hand, companies that I thought I'll be able to make a quick buck because they seem to be doing okay, but then the stock dropped in half. Well, I didn't even look why it dropped, right? I just thought, well, if it dropped in half, it has to come back. Well, that's not how it works, right? A lot of companies, they never come back. And so, yeah, I'm changing the way I'm investing. At this point, I'd rather invest in very good companies at an okay price than mediocre companies at amazing price. Because the amazing companies, they will be doing good no matter what. So even if you buy into them at only okay price, you're still going to make money, especially in the long term. But mediocre companies at an amazing price, well, it can go either way. I think on this, I will end this video. I will mention once again that I'm not a financial advisor. I'm simply providing this for entertainment and kind of allow people to follow what I'm investing in. But, you have to do your own research and figure out if this is for you or not, right? I hope you enjoyed this video and take care.